The Nasdaq is down almost 3%, especially its chip stocks, after Donald Trump said Taiwan should pay for its own defence. New Zealand's soft inflation figures support earlier rate cuts. ANZ Research now sees a cut in November. The Bank of England, though, will struggle to cut next month after strong British services inflation data overnight, thanks partly to Taylor Swift. That's coming up in 5 Things in 5 minutes. And then, in our bonus deep dive interview, ANZ Senior Asia Rate Strategist Jennifer Kusuma analyses the risks to economic growth in Asia over the second half of the year.
Considering how important export is as a growth engine in the region, a key risk to our outlook is, of course, if US demand slows into the second half of the year. We are also seeing headwinds from mainland China's growth.
But first, in 5 and 5 with ANZ, the Nasdaq is down almost 3% as of 4 a.m. Sydney-Melbourne time, especially its chip stocks. That's after Donald Trump said Taiwan should pay for its own defence. Taiwan's factories, of course, dominate global chip supplies. Chip stocks, in turn, dominate the Nasdaq. Nvidia was down 5%, AMD down 8%, ASML, which makes the chip machines that make the chips, it fell 11%. The broader S&P 500 was down less, 1.2%. The US dollar index was down 0.5%. The Aussie dollar flat at 67.27 US cents, while the Kiwi was up 0.5% at 60.78. The next big event for global rates is the European Central Bank meeting tonight. ANZ Head of Economics, Brian Martin, says a hold is expected after the 25 basis point cut in June, with the next cut expected to come in September.
We do think additional rate cuts are necessary, mainly because policy is restrictive. It's going to bear down on inflation. And growth is also operating below potential at the moment, and that too is bearing down on inflation. So we think the ECB needs to proceed with rate cuts and will cut rates by 200 basis points over this cycle, and that is necessary to ensure that inflation settles around target and not below it.
Number 2. New Zealand's inflation rate fell from 4% to 3.3% in the June quarter. That was below the Reserve Bank's forecast. Non-tradable inflation, though, was 5.4% after a 0.9% quarterly rise, and that was just above forecasts, but was due to an unusual rise in one transport subcomponent. ANZ economist Henry Russell says looking through that, the data was reassuring, with ANZ Research bringing forward its call for the first OCR cut from February next year to November.
We think the Q2 CPI data was a step along that path and pointing towards that those disinflationary dynamics are now emerging in the hard data. We think that's going to increase the Reserve Bank's confidence further. They obviously shifted their tone quite significantly in July at the July Monetary Policy Review, and we think today's inflation data will be reassuring for them, and that has caused us to revise our OCR call with the first cut coming in November. But we do see the risk tilted towards an earlier start.
Number 3. British inflation is staying higher for longer than expected, thanks to sticky domestic inflation, and services prices in particular. That inflation was 5.7% in June from a year ago, as economist Bansi Madhavani explains this morning from London.
A lot of this is attributed to spending boost during Taylor Swift's tour, as people spent on hotels, restaurants, beauty and personal services. The data will not add to Bank of England's confidence around achieving its inflation target. If anything, the last leg of getting inflation down is taking longer than the Bank of England thought. And our view is that the Bank of England may find it very hard to begin cutting rates in 2 weeks' time when they meet on the 1st of August.
Number 4. Bank Indonesia held its policy rate at 6.25% yesterday, as expected, to continue support for its currency. ANZ economist Crystal Tan says there is scope for a rate cut in the fourth quarter if external conditions are right.
The dollar-rupiah trajectory is going to be key. I think a sustained move below the 16,000 level, which is what BI views as consistent with the economy's fundamentals, is going to be a key level to watch. I think that would be necessary to pave the way for a rate cut.
Number 5. Australia's jobs figures for June later today are expected by the market to show unemployment ticking up from 4% to 4.1% and employment growth of around 20,000. ANZ senior economist Blair Chapman says jobs growth could be stronger due to an emerging trend of a firm June after weak May numbers. He's expecting unemployment to stay at 4%.
If we get what the market's expecting, I don't think the RBA is going to be moving either way off the back of it. It's really only if we see extraordinary strength or weakness that the RBA decision is going to be moved at the margin. I think really they'll be waiting for the Q2 CPI. But if we saw a weak unemployment rate, it would make it much harder for them to hike off the back of a slightly strong CPI. So it's really that combination of labour market and inflation, given the dual mandate the RBA has and the narrow path they've been walking.
Blair Chapman there. Now, in our bonus deep dive interview, ANZ Senior Asia Rate Strategist Kusuma has been on the road speaking to clients around the region and talks to my colleague Alex Tarrant about the main questions she fielded around Asia's growth outlook in the second half of the year.
We are expecting a slight moderation in the 2024 Asia GDP growth. We're expecting it about 4.8% for the region, mostly because of moderation in China and India. But for the rest of the region, we have been quite encouraged by the momentum was like in Q1. The composition of GDP growth in Asia has definitely shifted. Exports especially have re-emerged as a key growth driver in Q1.
And on your travels, you were asked a question by a few people, I think, which was what could interrupt that growth recovery in 2024?
Well, the region's export upturn is largely contingent on US demand, as well as the relative sophistication in the semiconductor industry, also how well plugged in an economy is to the global supply chain system. So considering how important export is as a growth engine in the region, a key risk to our outlook is, of course, if US demand slows into the second half of the year. We are also seeing headwinds from mainland China's growth. Now, China's Q2 GDP was out last week, and it suggested some slowdown in Q2 versus Q1. So we need to monitor this. And most of all, we also worry about the combination of weaker Chinese yuan in a real effective basis, as well as the falling export prices. This could weigh on the competitiveness of Asia ex-China's exports going forward.
Now, in a lot of the other parts of the world, everyone's banking on monetary policy easing as helping to underpin growth. But it seems like in Asia, the expectations for monetary policy easing are retreating. So just give us an overview of that and expectations for monetary policy, but also just what is going to drive markets if that monetary policy easing isn't there?
Well, for this year, support from both fiscal and monetary policies in the region, we do expect it to be quite mild. We have recalibrated our policy rate forecast, and in 2024, we are now only expecting rate cuts in mainland China, India, and South Korea. These have taken into account the external positions of Asian economies, the currently quite depressed interest rates in the region versus the US, as well as the need for the economies to cut rates to support growth. Based on these three considerations, we do think that the room for rate cuts would only be present in those three countries for the rest of this year. So in Asia, the support for monetary policy will be quite mild, but I think the bigger point here is that we do see broad-based support for our local markets that are away from the uncertainties in the domestic monetary policy outlook. So a few developments that we are monitoring. For example, we are expecting manageable bond issuance pipeline across our markets, but especially in India, Singapore, Malaysia, the Philippines, potentially. On the demand side, local markets will also be supported by strong domestic demand. Markets like India and Malaysia, for example, have deep and structural demand from their non-bank financial institutions. The anticipated index inclusion for India that started in June 2 weeks ago, and also potentially in Korean bonds in the future, this has been supporting foreign demand for local currency bonds. Lastly, I would say safe haven foreign inflows into the Singapore dollar and Korean won bond markets. That also positive for local markets in the region. So we are seeing broad-based support for local markets in Asia that will be less affected by whether or not the central bank cuts rates this year.
Kusuma there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, July the 18th. Catch you tomorrow with the details from Australia's jobs figures later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.